I thought I was getting
plans?
Oasis pre-sale tickets today.
I put in for them.
But I don't have access to the pre-sale.
Were they?
So I'm getting, listen.
Have you seen them before?
No. I hesitate to say this out loud because I don't want to compete for tickets. But next Future Proof, they play the Saturday night before at the Rose Bowl.
There's a 0% chance Oasis is playing Future Proof. 0.
No, at the Rose Bowl the night before Future Proof. So I'm going to Rose Bowl.
Okay, fine.
Yeah.
They are.
They're not going to Future Proof.
I saw them in 02, I think it was, on the tour of Brotherly Love.
Was that the last one?
Something like that. It was Space Hog. It was 3 bands that all had brothers. It was Space Hog, then it was the Black Crowes, and then it was Oasis.
Amazing.
That was a Radio City, I believe.
Josh,
what's
look at
your
this.
Wi-Fi password?
This is
that
me.
a thing?
This is
I
me in
probably don't even really
2006.
need it either.
My dad just sent this to me.
Should be fine.
2006. Look at the head of hair, though.
Pretty good.
Yeah, not bad.
Pretty good.
Not bad.
Pretty
Yeah,
good.
I didn't want to say anything, but it's a lot of hair.
It's a lot of hair. Yeah.
It's a lot of lettuce.
I was checked into a hotel one time, and the lady didn't understand the concept of going bald. She asked me what happened to my hair, and I said I lost it. She said where? And I said in the shower, and
Where
when
were you
it
checking
fell
in?
out, a hotel.
Suspect.
And she's like, "Wait, what?" I'm like, "Oh, what do you mean, wait, what? I went bald. Hello?" She never read it bald.
That's bizarre. Wait, where was this?
I thought so. At a hotel.
What country?
Look
Yeah,
at your
exactly.
head.
Was
Look
this
at
like
your head of hair.
Istanbul, where
No,
everyone
let's
has
not
like implants?
objectify
It's
each
like-
other.
It's like you don't even work on Wall Street. How do you have a full head of hair?
I don't have a full head of hair.
Did you go to Turkey?
It's like you're not even Jewish.
Do you know about
By the way,
Speaking
Happy New
of-
Year. Happy
And
New Year.
same to
Do
you.
you know about the people that go to Turkey and get the
I read
procedure?
something about it.
Why is it in Turkey? If we're in New Jersey, I would get it tonight.
I was unprepared to answer.
Vince Vaughn went to Turkey, apparently.
No, but
It's
do you
the
know why
government.
it's in Turkey?
It's because the lobbyists
They have-
have to, you have
They have the
go
best
through-
chemicals.
You got to go through health insurance, and it'll cost 20 times as much here, and it's an elective.
There are a lot of
procedure.
people that will just pay for it straight up here and don't need insurance. That can't be the only
Just
reason.
go
True.
bald. It's
I'm
great.
sure it's offered here somewhere.
It's not
You know,
great.
actually, you know what? It is offered here somewhere.
It is great.
I actually
Join us.
I actually wrote a research paper in
About
high school.
balds?
Yeah, in senior year of high school, about hair transplants. Believe it or not, it was about hair transplants, and it got into the history of hair transplants and wigs and how people I don't know if you know this, but way back in the day when people used to go bald. I'm talking like 16,
This was the part I
1700s.
wanted to cut.
Yeah.
Go ahead.
We'll get to finance in just a
Let
second.
him cook.
But in the 1500s, 1600s, when royalty would start losing their hair, they were really concerned about this. And one of the original procedures was to actually just cut out the flesh in the middle of the scalp and then stretch it, stretch the
No.
sides and tie it
Oh,
and sew it
Jesus.
together.
Or powdered wig.
Powdered wig, yeah.
Okay.
Ugh.
I know somebody that's
Mom?
seriously.
Well, what podcast is this again?
I know someone that's
man.
seriously considering going to Turkey. It's like you take a first class flight, they put you in a 5-star hotel,
Yep.
and I think you're done in like 3 days.
All right, before you get to this, I just want to say, Dan, we were after Future Proof. We were at the airport. It was me. It
Joe
was
Weisenthal.
me, Joe, Sam,
This is like a.
Josh was there. Phil Perman was there, and it was 5 minutes before 2:00 when the Fed was about to cut.
Can I guess what happened?
You saw this on Instagram?
I didn't see anything.
Okay, what?
Can I guess?
Go ahead. They cut.
The Fed cut.
Was there a
interest rates.
guy in
There
the
was.
airport
Dude,
playing "Here Comes the Sun"?
It was
on the
honestly,
car?
it was too much. It was like too much. I said, if I die now, this would be a great place
Wait,
to
that's
end
what,
it.
I wasn't there when the
You weren't there.
actual
Dude, it
decision
was
happened.
f***ing surreal. There was a guy playing Here Comes
I
the
saw
Sun
him,
as
the guitarist
it was-
in the airport.
It was unbelievable.
he literally started playing right at 2. It
Yeah.
was almost as if he was getting paid
Yeah.
from 2.
It was too much.
oh
Should
my
I go
God.
get the guitar and
It's
play "Here
unbelievable.
Comes the Sun" now?
It was too much. Yeah, John, play us in. Play us in.
No, we could.
All right.
We will
Do
get.
you guys have the budget for "Here Comes
we,
the
we
Sun"?
will get sued into the Stone Age if we play "Here Comes the Sun."
Be epic.
We could sing it. I'm told. Would you get your news from Amazon Prime, if they put Brian Williams on? Would you? I think I might.
Listen, you have to get your news from somewhere.
Elon Musk is my
And-
only source of news.
Let me ask you. Let me.
This
ask
is one of the
question.
few things that cable still has that streaming doesn't. And Amazon just hired Brian Williams to cover the election in November.
Listen, increasingly, obviously, are we live? Should we?
Yeah,
Go ahead. Yeah.
He just needs to make a flight. I'm all. He
We're-
led.
Nah,
with, he
I
needs
gotta
to be
make a. I
short.
gotta make a Rosh Hashanah dinner. That's what I gotta make.
He had he has to get home before
I'm hosting.
sundown.
I'm hosting now.
Or
By the way,
or he turns into a bagel.
Shout to Lido Kosher Deli. Nicole, you know about Lido Kosher Deli?
Of course I know.
I feel like that's anti-Semitic.
Thank you for catering. Wait, what did you just say? I turned into a matzo ball?
In a world where the stock market has been increasingly concentrated since the start of 2023, investors need to turn elsewhere for alpha.
One asset manager has found a way.
By screening for free cash flow margin, which is free cash flow divided by sales, the Pacer US Large Cap Cash Cows Growth Leaders ETF provides both holdings and sector diversification. Why does free cash flow margin matter? A high free cash flow margin suggests a company is efficient at converting its revenue into cash flow. If you want to learn more about the Pacer Cash Cow Growth Leaders ETF, I highly recommend you check out paceretfs.com/products/cowg. Oh! All right, this is the biggest investing podcast literally in the world. You guys are the reason why. And I'm telling you right now, this fall, we are coming so hard. We have some amazing shows planned. Today is the start of a legendary run we're about to go on. Let me tell you something. My two guests today are fan favorites, repeat guests. These are like among the best shows. It's not that we don't like new guests, but when we have killer podcast guests that the fans already know and love, it makes it a pleasure. And I'd like
What are
to...
you f***ing nuts? Messing with the mic?
Yeah, don't touch the mic,
Sam.
though. You'll be thrown right out of here. All right, guys. So without any further ado, let me tell you who's in the house today. Dan Greenhaus is the chief economist and strategist at Solus Alternative Asset Management. Solus manages over $3 billion for institutions and family offices and specializes in event-driven, distressed, and special situation investment opportunities. Welcome back, Dan. When we first started the podcast in 2021, I sent like 4 emails out to my favorite 4 people. And I said, we're going to do this show and you're going to be a regular. And here's what we're going to do. And it's going to be in person and the pandemic. We're going back to New York and blah, blah, blah. And I do this like 500-word email. And everybody I sent the email to responded with, I'm in. Except Sam was like, dude, this sounds amazing, but are you sure you want me? You remember this? I gotta find this email.
Sam's very arrogant.
You know, actually, it's funny you mentioned that. I was actually looking at that email thread.
Okay.
And
You're like, I'm terrible at this or something. What?
Yeah, no, it's like, this is not my thing.
Sam goes, me?
This is not my thing, because it's like, nothing gives me more anxiety than public speaking and, God forbid, TV podcasts.
I watched you give an interview at Future Proof to someone else, and I was like a third party. I wasn't even in it. You are 100% more comfortable now than you were a few years ago.
Well, yeah, I mean,
it's a big part of like
to be
what
honest,
you do now.
To be honest, when I came on to the, one of the first Compound and Friends, that was sort of my practice.
Yeah.
Right? And you actually caught me at an interesting time because, I mean, now this is like actually 2 or 3 jobs ago, but like it was a time when I was thinking, you know what, I think I might want to consider breaking out and going out on my own. In which case, you also have to do all your own marketing. Like, it's like when you go independent, you're responsible for getting the publicity out there. So
Right.
There was that part of this, there was that side of it that also pushed me. But, of course, when you reached out to me, that also is a big boost of confidence.
Oh, look at
it's
that.
like,
Look at you. Sam is the founder and author of Ticker, spelled TKER, an award-winning newsletter covering news, data, and insights informing long-term themes for investors in the economy. Both of you guys are reliable sources for me to like know what's going on. And so I just wanted to say thank you so much. And it's great having you back. With that being said, Google Notebook language model has taken the world by storm this week.
I got to tell you something. This is the 160th show.
Yeah.
And that was arguably your best transition.
Thank you so much.
With that being said,
That
that was
was
really
smooth.
good.
With that being said, I saw them on CNBC playing with this thing. So my point is, basically now you can just like make a podcast by typing a few words into an LLM.
Did Chris send you hours?
It's not. No, it's easier. It's easier than typing a few words. You just put
PDF.
You throw PDFs. You throw a chapter from a book. You throw research notes in, and you give it like 3 minutes, and it comes out with a 15 conversation between two people.
Dude,
So that's where I'm going with this. The four of us could each take a PDF of things we've written, throw it into a pot, and then we could go to Peter Luger.
Yeah.
And just let the AI do the show.
Yeah, I mean, I'm sorry, but like this could be the beginning of the.
Listen, if that's how we're going out.
No, but I mean, I think there's like there'll never be anything that replaces actual personalities. People don't come onto this podcast because it's two finance guys. It's Josh Brown and Michael Batnick.
Did you hear this thing? Did you like hear anybody make a version of this?
I don't know what's
So
an
if
LLM. Is that a thing?
I could take a research report.
No,
I'll
know,
save you some time.
that
Here,
you've written.
I think I have
and
this
make a
teed up.
podcast of you talking.
So what?
Actually,
do
this sounds
we have an
probably gonna be
example?
terrible.
So I've
Oh yeah. Hold on.
Try it.
hold on to the mic.
Oh, actually, hold on. Let me set this up. So a week ago, I took all of like the weekly sell side research notes from all the firms that come in, every Friday. I thumbed through some of them, and then I heard about this on TikTok of all places. And so I go to the website, and it says just drop files here. Drop 20 files in here. Comes out with a FAQ, comes out with outlines. It's incredible.
Who'd you put in there? Like chief strategist on Wall Street?
Well, that's the nice thing about this is it tells you all the sources. So why don't we just actually jump into this? But yeah, I throw 20 notes into this thing, and it comes back with a podcast.
All right, everyone, buckle up.
Hold it to the mic.
Because we are diving headfirst into a mountain of economic intel today.
Oh, yeah.
We're talking reports from
Sounds like
the
a
heavy
Bloomberg
hitters, BlackRock, BOFO, Deutsche Bank, even
BOFO.
Goldman Sachs.
BOFO.
The ones you hear about, like, make the news.
I think our job's to say for now.
Markets. And look, I know financial reports doesn't exactly scream thrilling Friday night, but hear me out.
It's drier than never.
Is this Joe and Tracy?
Just-
Wait, what?
Whoa.
What did you just say?
It's super informal, but wait, hold on a second. Let me
Sam.
I swear that this had nothing to do with me. It's
Sam,
personality.
that has everything to do
It's
with
the
you.
personality.
You
Wait, hold on.
pressed play.
Let me. Okay,
That's your
so
social history.
Who else
They
could it
get
have
to
to
say-
do with?
That shit is Sam GPT.
It's wild how this stuff actually hits home. It's not just numbers on a screen.
Exactly. It affects everyone.
Give it like 5 seconds.
Now let's talk about the big kahuna in the room. The 2024 election.
Oh, boy. Here we go.
Every election year is a little wild, right? Like economically speaking. But this one, wouldn't you say there's an extra layer of, I don't know, intensity, uncertainty?
Absolutely. This time feels different because the policy changes could be massive depending on who wins. I mean, you look at the Deutsche Bank, Morgan
This is very
Stanley
meta.
reports,
We're listening to a
they're
podcast on a
practically
podcast.
highlighting
No, this
the
is a new thing
differences
we're doing
between
now.
the two candidates, especially when
All
it
right,
comes
Sam, I
to
can't take
taxes.
anymore.
Yeah.
I like that she starts off as a pervert and then gets
Sam,
like
we're
really
trying to
deep on.
Is that the hot
Yeah, I know we're trying
version?
to keep it clean, but it's like they do such a nice job of like, hold on a second, this is like
I just want to make a quick point about this. So this particular LLM aside, when ChatGPT came out and we were talking about it internally, I think the important point for people at home, it's considerably more prevalent now and more well known than when we originally saw this. But where we're going with all of this, because that's a podcast Sam dropped in the notes, the information was fed to it, the voices are artificial, et cetera, et cetera. We now know you can obviously generate artificial faces, mouths, et cetera. Where this is going is in 5 years and 10 years, you're going to be able to go into your own SLM, a small language model, and say, I want to watch a Quentin Tarantino type movie starring Jessica Tandy. Jessica Tandy, I don't know where that came from, but
that's
starring
really
Jessica.
super specific, dude.
So Jessica
highly
Tandy and
specific.
Dolly Parton. It's set in 1970, film noir,
Right.
et cetera, and some version of ultimately your own content creation will be where this is going. And it started with, well, what if Tom Cruise played Iron Man? And
Yeah.
you just facial recognition drop Tom Cruise's face right onto Robert Downey Jr., et cetera, et cetera. But ultimately where this is going, and it's incredibly exciting, and it leads into one of the topics we're going to talk about Amazon News, where content is going to be 5 and 10 years from now is going to be one of the most exciting developments
It reminds me
of all of this.
It reminds me of hip hop in the sense of like, here's a crate of records from my parents' garage. I'm throwing a party. I'm gonna mix all these things up, and I'm gonna take like Sly and the Family Stone, and I'm gonna drop a breakbeat from Stevie Wonder on top of it, and I'm gonna create a whole new song. using things that already exist.
Yep.
So if I'm in the mood to watch a version of Iron Man where Tom Cruise is in the suit, I can do that sort of thing. Probably there'll be a whole lot of copyright laws and stuff involved. But
Well, you've already seen a couple of actors and actresses on the fringe. I'm sorry, singers.
Yeah.
I forget who it. Maybe it was Halsey. I don't remember. But when the Drake thing happened,
yeah, she said remix me, like
yeah,
do an AI me song, and I'll
Just
split
pay
the
me.
I'll
Yeah.
split the
for
royalties.
the
with you.
viewers out there, there was a moment in time where someone made a Drake beat, a Drake lyric, a Drake voice, and it ended up like #1 on the iTunes charts. And obviously, none of it was Drake. And there was this big outcry. And this is for the younger viewers out there. Go check out what happened with Napster in the 2000s, because I imagine we're going to go through something similar. But there was an artist, maybe it was Halsey, we don't know, who came out and said, use me, use whatever you want, just split the royalties with me. So right now, Tom Cruise is obviously not signing on to this, but at some point they're probably going to have to give way and allow people to do this sort of things.
The next generation of artists is going to have to be way more comfortable with people creating their own art based on them. It almost seems like that's going to be a prerequisite for stardom in the future.
I mean, you can already do it now. If you want to do a podcast, but in the voice of Donald Trump, you can tell ChatGPT or Perplexity, whatever, write me a 3-page paper about the Paleolithic era in the voice of Donald Trump, and it will do it.
Can you imagine the sick, twisted mind that would ask for that?
I just said it out loud, so I take offense.
So here's
But
my...
before it gets too dystopic, though, that does not mean movies made by directors and made by actual actors is going to go away. There was a big, gigantic AI report from Goldman Sachs a couple weeks ago exploring this, the idea of this dystopia scenario where everything gets replaced. But there's a long history of things that existed that got disrupted. Like, for instance, like sliced bread, right? Mass producing, white bread or something like that. You can buy a loaf of bread for 50 cents.
Silent movies.
Yeah, silent movies and all
There
this
were
stuff.
people that thought it was the end of the world because the movies had sound.
Right, exactly. But they were mentioning that the market for artisanal handmade bread is a multi-billion-dollar industry, and it continues to boom. So there will continue to be that supply out there because like with movies, there's going to be people who want to see something with real actors, with real directors, and all those little things that
I want to take it a step further. It's worth even more when everything is so easy. The authenticity becomes worth even more. And that's why you see Taylor Swift, who basically, you can listen to every Taylor Swift song in the world at the tips of your fingers. You have her whole catalog. You could watch endless videos of her online for free. But being in the same building that she's in performing is worth something that's literally priceless to the fans. And you can't just because it's a digital version doesn't mean that it replicates the real thing.
Right.
So
a lot of the humans are starting to fight back. The writers' strike, a lot of that was about protecting them from AI. Now the longshoremen strike is they're trying to they don't want automation replacing them. This is going to become a more and more frequent occurrence.
The problem with the automation argument is the U.S. ports are among the least efficient.
It's ridiculous. It's ridiculous.
Anybody can go look this up. They're incredibly inefficient. And I saw a quote this morning. Jim Garrity over at National Review, I believe it was Jim Garrity, found this old quote from the labor leader who said who was lamenting the decline of toll booth collectors.
Give me a fucking break.
His point was, oh, sure, everybody likes going through nice and quickly, but nobody gave a second thought to the union jobs that we lost as a result.
We were going to do this later, but let's stay on this port strike. Do you guys think that this is a material threat to the economy? Should it run on for 2 weeks or a month?
No.
If it runs on for 2 weeks or a month, no?
Wait.
Or you don't think it's going to run on?
I have no insight, but I think if it's 2 weeks or whatever, it has. You're talking for the 14 ports affected, roughly a quarter of the country's imports, a quarter of the country's exports come in through those ports. We've had strikes before, not too dissimilar to this one, so we can basically measure what traditionally happens. You end up with inventories building up, but then that obviously gets worked off subsequently. You're talking about something measured in
this union hasn't gone on
tenths.
strike in 50 years.
This one has not. That's correct. But there have been transport strikes before. If it's 2 weeks or even 3 weeks, this is not. The economy is pretty healthy right now. Would I run to Costco and stock up on sausages? No. But certainly, if it drags on a month, 2 months, 3 months, that's a different story. But 2 weeks, 3 weeks is
I think
no
to
effect.
Dan's point about the economy being healthy right now, I think that of if there was like any better time for this to happen, like it's probably
Sure.
now when inflation's under control and employment is very low. Unemployment is very low. People have incomes, people have savings so that they can actually spend and like, whatever. But let's also remember that, the biggest business story, one of the biggest business stories of the last 4 years has been global supply chain disruptions and how this was a huge problem for all these gigantic companies that have to go out and do business.
But doesn't it say they're not over yet?
It says they're not over, but they've had years to prepare for this kind of thing. Like there's already been reshoring and onshoring and all this kind of stuff. The way businesses manage inventories and just in time versus, whatever the
Just in case.
Just in case, yeah. The just in case inventory. Like just in case is more of a thing now than it was 2 years ago, for instance. So I think companies are just generally better prepared for this kind of thing.
Before we get into what people actually want to hear us talk about, the market and the economy. Josh, getting back to the thing you said about Brian Williams, nobody cares. Like, news is not a valuable property anymore. Who's watching CNN?
The thing that I'm saying, though, is the last two things that cable had that streaming didn't were live sports and news.
But is news still a valuable property?
Yes.
It is?
Yes.
I mean, Fox News is, obviously.
Extremely valuable. Fox News is one of the best businesses in the history of television.
But they're a unicorn.
So listen, I mean, it is accurate to state that the last two things that linear has is live news and live sports, and but the decline you've seen in subscriptions from 100 million down to 30 million now, and has been linear in nature. But you're probably reaching the end of the linearity in the sense that the 65-year-olds, the 66-year-olds,
They'll stay.
They're not going anywhere anytime soon. So I think you're going to see some leveling off from, call it a mid-single-digit decline annually in subscriptions to something a little less than that. I mean, that's my guess, obviously, if only because of inertia. There's just a lot of people out there that aren't interested in. I'm sorry, just real quick. Remember there was Aaron Judge's 60th home run game was only on Amazon.
Yeah.
And there was a humongous outcry among everyone's moms and dads because they didn't know how to watch the game. You can't have that happening every day if it's Dak Prescott or Aaron Judge or whatever sport it might be. Linear still has those people locked in, and they're not going anywhere.
They're getting us used to it. We're probably within 5 years of a streaming Super Bowl. We had a streaming-only playoff game.
Oh, no, I disagree.
Yeah, I disagree on that.
They're boiling us. They're boiling us, and we're going to get there.
Football is still...
It's today.
Yeah, I'm not saying we're not going there. And listen, you've got Thursday night football. You've got Thursday night football on Amazon. Basketball obviously is going to have some games
Wrestling
streaming.
on Netflix. That's a big
That's
millions and
a
millions
big
of
deal.
people.
Yeah, I actually just watched the McMahon documentary.
Sick.
What a
sick.
So they're going to have there's 3 nights of wrestling a week.
Did you watch it?
And
Not
one
yet,
of them will
not
be
yet.
Netflix.
Yeah,
Like they're
yeah.
getting us used to it.
No, that Netflix has said all along, more recently, live sports, video games, et cetera, I don't listen sports, especially with what's going on at the regional sports networks, with Bally's and baseball in particular, but hockey as well.
Yeah.
There's a lot of linear just can't afford everything that's happening right now, so it's got to find other distributors.
If CNBC went on Peacock and the MSG network were like thrown into an ESPN bundle, I might seriously cancel my cable.
You could
and
stream
just-
You can
MSG.
stream CNBC right
No,
now.
I just don't want more things. I'm saying like
That's
the
why.
last few things that I genuinely news and sports are the last 2 reasons to keep any cable subscription and not just strip it down to broadband
So yeah, I mean,
only.
it seems ominous for cable, but as far as like the
But great
business,
for broadband.
yeah, it's great for broadband. Probably,
Right.
yeah. I mean, I actually came into this conversation thinking everyone's going to say that this is a terrible idea for Amazon, but it sounds like an interesting.
They're going to do
I
it.
think it's a terrible idea. Nobody's watching Brian Williams on Amazon.
Well,
we'll
of course
see.
they will. Of
We'll
course
see.
they will.
They're paying for it anyway. They're prime
keep in
users.
mind, I mean, the thing about the news business is the hardest thing to do in media is get audience. And so, which is why you'll hear about all these startups that, hire 100 people and then they shut down in a couple of weeks because they can't figure out how to get people. Amazon is one of the most visited
They're already
properties.
there.
Yeah, they're already there. So it's just a matter of like putting something in front of this empty space.
But to be clear, these properties have value. You mentioned Fox. Take a look at the stock price. Obviously, there's issues with subscriptions. There's no doubt about that. And all of these guys are trying to get other revenue streams. The New York Times is a perfect example. The New York Times, when Trump took office,
Juggernaut.
was $10 a share. Now it's $50 a share. They're charging you to play Wordle. They're charging you for cooking. So it's not that you don't need alternative revenue streams, but people still want news, and that's obviously print. And with respect to television, like there was a lot of lamenting about Tucker leaving Fox and what that would do to viewership. And there's no doubt that Jesse at 8 has a smaller viewership
First
base.
name basis.
Who's Jesse?
Jesse Waters at 8
Oh,
o'clock.
Jesse Waters. Yeah, sure. I don't watch that shit.
Okay, well, but
Sally Jesse?
Sally
definitely
Jesse
not
Waters.
Sally Jesse Raphael for the, but there's no doubt that viewership is not, but there is a locked-in audience for MSNBC and CNBC called 1 million. There's a locked-in audience for Fox, call it 2 to 3 million, depending on whether it's hard news or the opinion hosts. Those people are not going anywhere, and so people do like real-time news, and from Amazon's standpoint, you want people. Listen, you want people watching. Now, is Brian Williams going to draw people? I mean, listen, CNBC tried this with Shep Smith. CNN tried it with Chris Wallace. These guys probably don't have an entrenched audience that goes.
Yeah.
Well, you said those people aren't going anywhere. They're dying. I mean, not to be crass, but they're not getting any more viewers. The old people watch news and nobody else knows.
But the thing is, it's like if you're an Amazon customer or if you're on Prime, you have to go somewhere else to get news. And
right. Once you don't have to.
Once you don't have to. Yeah. And some people will leave, but it's a question of how many people are they able to keep on. And, whatever this Amazon news venture is going to be, they're not dealing with all the legacy issues and legacy costs of all these.
If we see a presidential debate, these are arguably the biggest nights for the news, is the election nights and debate nights. And then, obviously, God forbid something terrible happens. But like those are the big nights. If for whatever reason, one of the streamers locks down a presidential debate and they're showing it live, that'll be a sign that,
to be clear, there's absolutely no reason, especially after what's happened in the last 4 and 8 years with the breakdown of the presidential commission and how it traditionally organized these things. There's absolutely no reason why a streaming service cannot have a presidential level debate.
Yeah.
Zero reason.
And somebody will get one.
Yeah,
and
absolutely.
somebody will get one. So the debate was this week. We're going to get into that in a second. The vice presidential debate was this week. And I was watching something on a streamer. And if there had been like a little pop-up in the corner, hey, the debate is starting right now, I never would have left the app. The only reason I'm back on the cable and I have to use a different remote is because there's something on the news that is not on the streamer.
Well, could it be syndicated on the streamers?
Simulcast it?
Yeah.
Sure.
Absolutely.
100%. Yeah. All right. Is the stock market getting ahead of itself?
Why'd you ask it like the church lady?
You said something very smart last time you were on, and I want to remind you what you said.
Oh, well.
I asked about the
Knicks should trade for Karl Anthony Towns?
No. I asked about the odds that you were on March 15th. It's not that long ago. I said, what are the odds that another country could outperform the United States in 2024? And you said Chinese stocks have a good chance of catching up. Well, shit. I mean, that's like it's the best performing large market in the world.
Yeah,
I said that entire sentence?
No, I added the last part. You nailed it.
Okay.
Bullish because of an expanded middle class. You mentioned LVS, TRIP. TRIP's up 51%. LVS is only up 3%. Split the difference.
And he said it was going to be in late September.
No, but I don't think anybody was saying like China is the bet this year.
Hold on a second.
Yeah.
Go ahead.
I'm almost positive that was Peter Bookvar who was on with me.
Yeah.
You think that was him?
Yeah. I'll take credit for it.
That was on that show then.
Someone's
Yes,
getting
but
fired.
Peter has been, and here he is.
Or hired.
So, all right, but
I
you
think
sat
that was
next to Peter, and let's
did.
be honest, that's like the important part.
Yes, I'll take credit for osmosis. But
You got to be surprised. Either way, the point is you got to be surprised by the strength in the U.S. market, and of course, obviously, foreign markets, China, India.
yeah, listen, I've grown up in an era, we've all grown up in an era where the U.S. market has just consistently outperformed for any number of reasons that viewers may or may not be aware. And after 20 years of people telling me diversify, just being in U.S. stocks, particularly high growth stocks, for much of that time has been
Fine.
been just fine.
Missing nothing.
And I also listen. There's tons of research that tells you geographical diversification is a benefit to portfolio performance, and I leave that out there to the RAs to impart that wisdom onto their investors and clients. But from my standpoint, the S&P 500 is pretty geographically diversified itself. And if you are a retail investor out there, I don't know that I need much more geographic diversification than the spider already provides me.
That's Bogle. Bogle
Yeah,
had
you
that
get,
thought. Bogle thought that.
yeah, like 40%, 30 to 40% of S&P 500 revenue is coming from abroad. So
that was Jack. So Vanguard was selling a ton of international ETFs.
Right.
And Jack was like, "Don't need them."
Yeah, I mean, if you're actually buying international stocks, companies that are run out of Europe and Asia or whatever, I
Yeah.
feel like that's more of like a corporate governance play or a cultural play or a capitalism play. Whereas like, you could have, a US run company with the US brand of capitalism operating in France, or you can have a French run company operating there with their sort of approach to how business is done.
Yeah.
And so it's a question of how
and
those
their
companies,
tax rates and their we have like casino companies in the United States that effectively are getting all their growth from China.
Right.
Those trade like proxies.
And yeah, I mean, if you like, another way of looking at this too is like, automakers. This was particularly a big issue, like during the financial crisis. Why are all these automakers failing when, these Japanese automakers operate differently? And you have all these things ranging from unions and pay and how the companies operate. So, like, yeah, maybe in that sense, you have two businesses that both have U.S. exposure, but it's a question of how the companies.
If
are run.
China does 30% this year and 30% next year, it's going to be a 5% weighting in like a quarter of all wealth management portfolios.
I saw a
just
stat
because that's how it
today
works.
from Brendan Ahern, answer to a client question: how much dry powder do Chinese citizens have? There's $43 trillion in bank deposits. Is that a real data point?
You can't look at Chinese data points the same and impart U.S.
43 trillion yuan?
Yeah, not dollars.
All right, calm down.
It says dollars.
43.
Really?
Well, whatever the number
That
is,
sounds
it's-
unlikely.
It's hard to impart U.S. investing acumen approach to the Chinese market. It's just the Chinese economy.
It's a lot of yuan on the sidelines. I'm just saying. So
you should just go home now.
we got some good data today out of these here United States. Carl Quintanilla tweeted highest ISM services since February 2023, highest new orders since February 2023, and I believe Josh, isn't that Nick Holtz's favorite data point, or is it Sembelis? One of them said new orders is what you want to look at. So new orders highest since February 23, highest prices paid since January, weakest employment since June. We've been talking about a bullish backdrop here on this show for a couple of weeks, but I want to ask the question to Josh's accent, like, are we getting ahead of ourselves in terms of performance? We've got S&P 500 forward PE.
People are saying the G word now.
At
too.
what, Goldilocks? Like, are we discounting too much?
Growing economy, rising earnings, falling interest rates.
Oh, Dan's
People-
shaking his head. Let him cook.
Listen
Go
to me.
ahead.
They're saying it. I'm not saying it.
Who's they?
They.
The Illuminati?
I talked to many
Brian
people saying
Williams.
this.
Yeah.
Listen,
Amazon News is.
I implore viewers.
Just tremendous.
I implore the viewers and the listeners out there to heed these words. For the last 20 years, let's just say since 2010, there has been a large group of people who at any moment in time would come out and tell you the 5 or 10 reasons why you should not be investing in the U.S. stock market.
Of course.
And I sent over to you guys because I knew something like this was going to come up. Clips, I don't know if we have it, but screen grabs of various newspaper articles from 2014,
Do we have
2015,
that?
2016.
On screen.
Oh, look at that.
John.
I want it, by the way, while we have it, I want to draw everyone. Oh, it's not up there. I
Read-
found one written by Sam
Oh, really?
Oh,
in
me?
2014.
No, in his defense, he was at Business Insider. It's not his fault.
It was
So
business. It was a
Hey,
business.
I was just a messenger.
Fine. But
Hold
the
on.
point.
Read these headlines.
Okay,
for the
so
listener.
for the listeners, here's Jesse Solomon, CNN in 2014. 4 signs that the stock market is overheating.
Thanks, Jesse.
There's Market Watch in 2016. This is Forbes at the top. How the S&P became expensive. 2016 and 2015 on the right. One is USA Today, and the other is I don't know what. But the point is these are just obviously one moment in time.
Brett Aaron's Why the U.S. Stock Market is one of the most
He wrote
dangerous
a
in
lot
the
of
world.
those. All right, so Dan is obviously complacent. Sam, let me ask you.
No, I agree with that sentiment. Especially, I like the idea of going back into history with these conversations and a lot of those headlines, by the way, address valuations,
Yep.
PE ratios, price sales ratios, which, by the way, is like the world's worst timing.
That's how you lose money in the market.
Yeah.
That's how you lose money in the market. Valuations are too high. I'm going to sell or I'm going to be out of the stock
It's
market.
almost like we deserve a premium.
Historically high.
I mean, and the thing is, it's like, in a given moment in time, you can probably say, oh, yeah, stocks look expensive. But you're also battling with time there, right? Especially in an economy and a world where earnings tend to trend higher, right? If we're looking at, expected earnings growth, that's double digit year over year. And who knows how accurate this stuff is, but historically it's been pretty consistent. you're dealing with valuations where the denominator is now increasing. So as time passes, every quarter passes, the denominator is getting bigger. So you can actually have a scenario where valuations are coming down, but stock prices continue going higher because the earnings are catching up.
NVIDIA.
So yeah,
NVIDIA's a great example of that.
like valuations is disastrous,
especially when you
reason to
add
me.
buybacks into the mix.
That too.
You have companies that are now capable of, on a yearly basis, buying $5, $10, and $15 billion worth of stock. I'm not talking about Apple. I'm talking about like your rank and file S&P 100 large cap can retire $10 billion worth of shares a year. This is another way where market caps don't climb, valuations don't climb, but stock prices do.
But I want to get back to the essence of your question. I just spoke to Dan Nathan about this. So the economy, so if we stipulate and accept as facts, the economy is doing fine, earnings are continuing to grow. There's no imminent signs of a recession or any sort of financial crisis along the lines of what we've experienced in our lifetimes. So the stock market, all else equal, should go up in that type of an environment. And yet we find ourselves saying, well, are we getting a little ahead of ourselves here? And what I find just so amazing, inherent in that question, which you're not asking out of the blue, obviously, there's all this stuff in the ether that would lead one to ask that. What I just find amazing is in the face of this resiliency in corporate profits and the economy, the reluctance of any number of investors to just go, oh, okay, we're doing okay.
I'm bullish.
Like, I'm bullish.
People are afraid to make money.
But when you say, is the market getting ahead of itself? When anyone's...
Who am I to know?
No, it's not even that. It's like, what you're not saying is, am I wrong to buy? You're saying, like, are prices like just too advanced and they'll get there eventually, but they've gotten there too quickly? That's what you're really asking.
The market goes up. The real question, it's not whether, like, when I as a strategist come out and say, I think the market's going to 6,000 or something, it's going to get to 6,000, whether it's today, tomorrow, or the next day. That's not, like, the real money is made in your sector dispersion. And there's plenty of research to bear this out. Some I've done, some elsewhere. Like, saying this market goes up, that's no great feat. Being perma-bullish is just duh. The question becomes, do I want to continue to overweight tech stocks in this type of environment? Do I want to continue allocating to semiconductors, or do I think cyclicals, or do I think defenses, or those are the decisions that ultimately generate the type of alpha that lead to, at least on the retail side of things, outperformance. On the institutional side of things, you're trying to find names that are either underappreciated or undervalued in that type of environment. But again, with that backdrop, I don't understand. I've felt this way for 2 years. I go on TV or I talk to people who are bearish, and I don't understand.
Because let me fill in the blank for you. It's super embarrassing to, in an unqualified way, say, buy them here, I'm bullish. If they fall, it's way less embarrassing to say, yes, but, and then they fall, and you say, but I said, but, like, I gave you the caveat.
When I switched to the hedge fund from the sell side, one of my friends, former clients, friends who was on the buy side, used to tell me, there's no such thing as constructive, or there's no such thing as I'm nervously bullish or anything. You're either long or you're short.
Well, yeah. In fact,
you're either long or you're short. And I bring that up because the number of people that go on TV
cautiously optimistic.
I'm sorry, I was struggling to remember cautiously optimistic. There is no cautiously optimistic. The number of people who go on TV and talk reluctantly, nervously, cite bearish or negative statistics or observations and are fully invested.
Stop hedging.
Is numerous.
It's a commentator stop loss.
Yeah,
that's
But it's a career. But it's a career survival.
I get it.
kit.
But the people listening and the people watching, watch these people and go, well, the person I like was cautiously. I'm going to dial down, or I'm going to tell my guy to sell this or that, or girl.
Yeah.
Like,
it's not helping anybody.
So it's not helping anybody.
Speaking of the people watching, so Josh, I don't know if you guys know this about Josh. Josh doesn't think highly of himself. He has a very low ego. So let me allow myself to pick Josh up off the mat.
I can't even tell if you're being sarcastic or not.
I'm being very sarcastic.
Okay.
However,
thank you for that.
However, our friend Phil Huber just texted me this. A watcher of CNBC apparently is Bill Gross.
Okay.
Bill Gross tweeted, Josh Brown on CNBC today quotes the turkey from Jesse Livermore's tome. It's a bull market, Not so sure myself, but anyone with the scope of financial history like Josh should be respected. I watch him as much as possible, smart investor. Bill fucking Gross tweeted that about Josh Brown.
I met Bill for the first time at Future Proof last year. Did
you talk stamps?
I didn't get like 10 minutes with him. I got 5 minutes, and I used 1 minute of that to set up a selfie. But it's the legendary Bill Gross. Like, what could be better than that?
Bill Gross
Maybe I should go back to Twitter. Are people saying nice things like that about me all the time?
I doubt it.
Okay.
Bill Gross
Yeah,
hired
you're
Tony
good.
Crescenzi, my boss, so to speak, at
I
Miller
remember that.
Tayback, and that allowed
Yeah.
me to be the chief strategist at Miller Tayback.
All right, so Dan, I hear
shout
you.
out to
And
Bill
listen,
Gross.
we're with you. Josh and I have been very constructive because how could you not be? We're just trying to give maybe a little bit of, I'm trying to give a Grand Rapids hedge myself because I don't get embarrassed. So here's this. From Marlin Capital, the S&P 500 forward PE at the month of the first Fed cut is the highest it's been in history. This is a pretty neat chart. Again, is it meaningful? I think to me, listen, why shouldn't multiples be elevated? We have a very bullish backdrop.
I think the other thing to remember, and Sam, I've been talking a lot. I apologize,
No,
but
you got it.
the other thing to remember is that historical analogies, whether it's this or the last time the Fed cut by 50 basis points types of observations, is you have to remember you have to keep in mind you have to keep in mind the uniqueness of this situation in the sense that
Yeah, I agree.
unlike previous instances, there's no, granted in retrospect, but even at the time, there's no obvious issues arising the way that there were in 2000 with just the incredible rally in stocks in 1999 and certainly the back half. You had stocks splitting 2-3 times per year, trading at 100 times assumed EPS, let alone actual EPS. Obviously, 2007, you'd already had down you'd already seen the breakdown of the mortgage market, of the credit markets. So there were all sorts of warning
And
signs.
this is not that.
As I've said before, my job as a strategist in an actual sense is, as I put it, to try to see today that which tomorrow is so obvious in retrospect. And I look around and I point to me the thing about which I should be worried. And the items that get cited to me are credit card debt is high,
The
or
Strait of Hormuz.
the Strait of Hormuz, which might be a real issue for the moment.
Yeah,
but
no, I don't mean to laugh at it. It's like nervous laughter.
Okay, this
But-
That's
but-
the
Yeah,
thing.
but you know, if you're putting together a list of like what's the thing that's going to make me nervous in booms and busts alike, there's always going to be a Strait of Hormuz in every boom.
where is
in
COVID
history.
on people's worries list? It's always what we don't
Maybe
see.
the Strait
Yeah,
of
that's-
Hormuz
well, that-
was.
that's
That's
true.
what risk is. It's
No,
Of course.
it's not always what you don't see. We saw the housing market
Okay,
coming
fine.
for
Yeah, fine.
3 years.
Barry did.
Barry,
4 years. I want to ask you guys. Let's move the puck a little bit off of valuation. Let's do this.
All right, so
This blue chart.
people, this is, I don't know, maybe you guys could explain this to me. When I see this, I'm like, all right, I see what it says. I don't know what it means. This is from Daily Chart Book via Goldman. Via Morgan? This is a via. Sorry. Non-dealer in U.S. equity futures is at record highs. So this is all investors, less market makers. Okay, so people are bullish.
It's futures positioning, and it's implying that like everybody is
Yeah.
bulled up.
This is a dun type of chart.
This is
Dan, you
net?
buy this?
this is net.
It's always net unless it says otherwise. I don't know.
It says net, yes.
Is it gross exposure or
Yeah,
net?
It says net. It says net.
Well, listen, people are bullish for sure. Forget how they talk.
But why wouldn't they
But
be?
why wouldn't you be?
Yeah.
But also the important thing to remember about the futures data in general is you don't know what else is going on in a portfolio. And this is one of those things like cash on the sidelines, which I hope we'll talk about in a minute, that people just cite as if it's in and of itself an important data point. I could be incredibly short in much of my book and be long futures as a hedge.
And this is only capturing one part.
This is
of
only
your-
capturing one side of the
Right.
ledger. But listen, we know people are dialing up risk. That's not to the extreme that perhaps this chart suggests. But we know people are dialing up risk because the Fed is cutting rates. Getting back to the valuation conversation, that is a function of
If your
enthusiasm.
knee-jerk reaction is to get bearish when people are bullish, that's a very good way to lose money over a very long period of time.
Well, listen, real money is made going against the crowd. I think most asset managers would tell you where
not every day though.
but not every day. That's right. Yes, that's right.
not habitually.
So
I
this-
mean, one more thing I'd add, not that I'm any kind of expert in this. I mean, this is net, but we're also still talking about nominal dollars. And, you know, everything.
Oh, that's a good point.
That's true.
Everything
The
in nominal
market cap
dollars
size is so much bigger
yeah,
now.
everything is much bigger now. So, you know, household net worth, stock market.
So-
This doesn't look like it's adjusted for like overall S&P market
So, Sam,
cap.
you're
or
gonna
anything
love-
like that.
inflation. And
You're
all
going to
that
love
stuff.
an adjustment that we have coming up, so stay tuned for that.
All
This
right.
surprised the hell out of me. 5-year and 10-year returns. I was going to ask a question and
Rolling 5-year
but
return, including
I was going to
dividends.
say, when you guys guess that they're higher than average, because when I saw this chart, I was really surprised. I assumed that for the last 5 years, certainly for the last 10 years, returns are at the upper decile historically, and that's not true. So over the last 5 years, we're up 110%, which is higher than the average of 73%, but it's nowhere near prior euphoric peaks. Next chart, 10 years, zooming out a little bit more. Again, higher than average, 250 versus 204 historically, but not this alone is nothing.
It's not the late 90s.
Not even close.
It's not the late.
It's not the 50s. It's not.
Yeah.
It's not even close.
So coincidentally, I was running similar numbers for myself because I'm actually coming up on the 3rd year anniversary of my newsletter. It's next week. Thank you. And so every year,
Bro, we should go out that night and get annihilated.
let's do it. I'm all about it. I'm all about it because for this stat alone,
All right.
right? So year one, I launched in 2021, October 2021, a newsletter about how the stock market usually goes up.
Good timing, asshole.
Great timing. Market goes down for 19%. 19%. All right. The stock market usually goes up. Newsletter stocks go down 19%.
Subscriptions exploded.
Subscriptions were actually really good because that's when people sign
Low
up for
base.
stuff.
Low
Exactly.
base.
Well, low base. All right. Okay, enough of that.
Base effects.
We're getting lost here a little bit. Year two, the market goes up 19%. Year three, to date, today, the market's up about 30%. So 30, 19, minus 19. Average annualized returns for the last 3 years is 9%.
It's like magic.
Boom.
Isn't that hilarious?
The train's never late.
Yeah, I mean, it's funny. It also speaks to this whole issue of average annual returns in the stock market, right? Everyone always tells you, oh, it's 8, 9, 10%. But 8, 9, 10% doesn't happen.
Never.
No.
You get 9%, 10% average annual returns because you have a minus 19% year. You have a plus 19% year, and you have a plus 30% year.
Yeah,
This-
you,
I'm
you
sorry,
need the down to get the average.
I want to. This is another thing that bothers me so much.
okay.
The average return is call it upper single digits. Is upper single digits when you average, but
7% in real terms.
and everyone go, oh, but you never get 7% or 8% returns, whether you include dividends or not. But this bothers me so much. That's including down 50% years.
Yeah.
Up
Yes.
years,
Yes.
which is what happens most of the time,
Plus
is
20.
way
Yeah, it's
better.
30. Yeah.
Absolutely.
Way better than
Yeah.
upper
You're
single
more likely to be up
digits.
20%
So
than
frequent.
down.
Yeah. I mean,
it's just a-
20% years are actually not, from a mode standpoint, if we all remember.
Mode. You modal
If we
son of a
remember
bitch.
high school mathematics, mean, median, and mode,
I stopped after median.
Yeah.
I never learned mode.
20% years or within a reasonable range of that is pretty
Well,
common.
just think
You
about
do know mode. I've seen you put the chart out.
think about recent history. Like 2017 was plus 30. 2019 was plus 27. These were normal bull market years. They weren't outrageous by historical standards, and those are insane returns.
But what happens when you have people on TV and in print constantly saying an average year is 7%?
Yeah.
Well, because they're probably talking about long-term investing,
No, I'll tell
and then
you.
it's true.
No. Well, yes, fine.
Yeah,
Yes.
on an annualized basis over time, but the frequency of 7%.
but
it never
I know what
happens.
I know what you were saying. Who did we have on last week?
Tom Lee.
So we asked Tom Lee about, like, you're not one of these guys that just, wherever the market starts the year, add 8% in stock price growth, 5% earnings growth. Because to that point, it's not going to be 8%. It's going to be plus 20 or minus 10.
So two things. One, whatever one thinks about Tom Lee knows what he's talking about.
Tom Lee is a
And
goddamn
right.
hero in this room. I'll tell you right now.
That aside, I mean, Tom, as everyone knows, was like I have much more. I have a lot of respect for having been one. Institutional sell side strategists are different from a lot of other people who call themselves strategists. Tom knows what he's talking about, and it's why when we all come on CNBC to start the year and say the S&P is going to be up 13%, everyone goes, "Oh wow, that's a." But no,
You must be wildly bullish.
It must be wild.
No, that's what a bull market looks
That's what a
like.
bull market
So
looks
what
like.
about this grinds your gears?
No, this wasn't what grinds my gears.
So what does?
There was the cash on the sidelines.
We'll get there.
We're going.
Chill.
Wait, I want to do the
I didn't bring-
Chinese.
you just brought
I want
it
to do
up.
the Chinese stock market chart. because
We're
this
doing
is-
it. We're
This
doing
is a
it.
top 5 market story of the year. Chart Kid Matt did this unprecedented surge in Chinese stocks, and basically what you're looking at is the MSCI China Index back 30 years, And what are
And
we
the
trying to
last
say
two
with the
times,
forward returns?
I got it. I can
All right.
interpret this chart. Let me cook. The last 2 times this happened, the forward returns are pretty good, up 50 and up 70.
The last time after a surge.
The last time after we got, so we're up 33% over the last 10 days. The last 2 times that you had, because that's only happened 2 other times, and I'm teasing, it's a small sample size, but
Does this have a
nevertheless,
I was going to
Double
say, in
y-axis?
statistics class, we're
Yeah.
told n equals 2 is insufficient.
Is this a double Y
it's a double Y. But let's keep going because we got
In-
more
in
charts to
theory,
run
it's
through.
2 charts.
We got more charts.
Technically,
So
it's 2
David
charts.
Inglis tweeted, China is now the world's best performing market this year. For fund managers, the rally may have reached a point where not owning anything China means the risk of underperforming the peers is material. The reversal higher the last 3 weeks has been mental. And I would agree with him. That's a technical term. This is out of control, just straight higher. Katie Greifeld tweeted, K-Web took in $700 million yesterday, its biggest inflow
I'm
ever.
proud of those units.
And of course, we've got to get the crack investors involved. And I mean that not pejoratively, as a term of endearment. Yin, which is the 3-time levered one, this is from Balchunas. Yin's weekly historical volume chart is insane. There's still 2 days left to go in this week, and it's already destroyed the record. And so here's the coup de grace. Okay,
I'm sorry, there's a 3 times levered Chinese stock.
damn right there is.
Yin and yang.
Yeah, it's yin and
what
yang.
do you think yang does?
It's the bear. So chart. But we spoke about.
I'm long both of those.
We
by
didn't
the
make
way.
we didn't make these things up.
That's a
They
pure
really-
lock in the negative arbitrage.
They
So
really
this
exist.
is what you have to do with flows charts. I said to Matt this morning, we have to normalize this because as Sam mentioned, of course, the dollars are bigger now, right? So it tells you nothing, but you go back 15 years. So what we did was we look at the 6-day sum of the 6 biggest ETFs as a percentage of total assets, because it's not the dollars, it's the percentage of the total assets. And even when you normalize it, it's even more impressive. So 16% of the total assets in these 6 funds have come in over the last 6 days, which blows away anything we've seen over the last decade. So people are really moving.
You can only get this after a 15-year period of underperformance where not only are people underweight, they've just literally written off the asset class. You got stocks in these indices that are 7 times earnings with 20 or 30% of the market cap sitting in cash. And that's the only conditions.
And think
in
about the
which you can get
43
this.
trillion, Dan.
So
we don't believe that number.
I think when all is said and done, the sum total of the Chinese stimulus will probably amount to somewhere around 5-6% of GDP, which is a pretty
It's a lot.
sizable.
There's a big multiplier on that too.
Yeah.
'Cause
Well, listen,
maybe.
yes, but listen, there are solutions that China is not willing to do that are more free market oriented that will be better for them in the long term. But in the short term, you're talking about easing up some of the restrictions in the housing market. You're talking about injecting money into banks and fomenting additional lending, and ultimately potentially setting up a fund to just like outright buy stocks. All of that is in the short term incredibly bullish, and it's the underpinnings of all the charts that we just looked through. But I would also just add, as someone who believes a lot in free market capitalism and free markets in general, this is not how you solve what's wrong with.
With all due respect, the Fed and Treasury threw a combined $21 trillion at the stock market 3 years ago, and it jump-started the economy. There's you can't say I don't like their intervention, I only like ours.
No, well, hold on. I didn't say I liked ours.
Okay.
That's first of all.
But it worked.
But
How many votes? How many votes do you have now? Like you can't say it didn't work.
so
what we did here, it worked.
just for the audience who's already mad at me because I said I
know
ate a
you're
Peter
not.
Luger last time, and you brought it up again.
Wait, what happened last time about Peter Luger? I don't remember.
We were talking about inflation. I brought up Peter Luger, and a bunch of people in the comments were like, "That rich guy eating a Peter
Yeah, you're
Luger."
the only one eating a steak.
I'm a vegetarian. But anyway,
Sam's giggling.
Hey,
'cause-
don't bring me into this.
No, but you and Lynette sent me a video from Peter Luger last week.
So
What happened?
Literally last week.
it's a bull market, man.
It's a
Sorry.
bull market.
I go
We're
to
long.
Outback, so a steak at Outback. But now I've completely lost the point I was going to make.
It was a good one though, I bet.
We were about to get sidetracked by the difference between our state intervention
go ahead.
and their state
Go ahead.
intervention.
I mean, do you have like a very strong take on why it's so different? Because I don't.
Well, again, the implication was that I liked what we did, but the only thing I would add, and then I'm happy to move on so that he can make his train, is just there's been a lot of research that bears out that shows the idea that at the zero lower bound, when the Fed is at zero, fiscal policy becomes the more dominant factor in terms of generating
They
output.
did both though.
Yes, but what you saw in 2020 that you did not see in 2008, and this is a much longer conversation about why we saw inflation this time and we didn't last time, is these decades of papers that have been written saying when you get to zero and monetary policy is exhausted at stimulus, the government can dig holes and fill them up and have a much greater multiplier effect. What you saw in 2020 was exactly that. Why did the Bush checks in 2001 after 9/11, I think it was after 9/11, not have the same type of economic effect, or the Cash for Clunkers program, or the or any of the stuff, the fiscal packages that we had after 2008? Why did they not have nearly the effect that happened in 2020 when we put $2,000 in people's bank accounts and spent $6 trillion as?
What's the answer?
The answer is at the zero lower bound, which is where you were this time around. Exactly what the government did is going to have exactly the type of stimulative effect that happened. Now, granted, we paid companies to keep people on board, and so that the link between employees and their work, the employers and employees, were not severed, and we gave people $2,000 to spend. And just to oversimplify it, in 2008, I bought your watch, JP Morgan, and your watch is worth $100, and I took your watch and I gave you $100. I didn't make you any better off per se. I liquefied you, but I didn't really make you any better off. This time around, I said, keep your watch, and here's $100, and here's $200.
Yeah.
That has a meaningfully different effect. The research showed, and now in practice it happened. Now, again, is this better or worse than what China's doing? I mean, they're both another podcast.
Well, China's doing theirs outside of an emergency. We did ours in an emergency.
Sure.
So
Wait, there's an emergency in China.
What, for property investors? Yes.
Yeah.
Well, I know they have high unemployment. And I know they're,
youth unemployment is high. But listen, when the problem with picking winners and losers, and this is a fun conversation on Fox in the evening, but like in reality, the government shouldn't be picking winners and losers. And when you decide property investment, for in some cases justifiable reasons, property investment is going to be the investment vehicle by which we're going to spur economic growth, consumption, savings, et cetera, et cetera. What do you do when you run out of properties to build or to sell or in inventory, or insert your word here? You need to pivot to something else. And instead what they're trying to do is just spur more property. Well, I'm going to cut the down payment for second mortgages, for second homes. I don't.
You don't sound like you think what they're doing is going to work, or do I have that wrong?
In the medium term, no, I don't think so.
Okay.
I think in the short term, it could be.
So you would be thinking about the best way to fade this Chinese rally that we've just documented.
I would argue for a country to be successful in the long term, and we now have lots of evidence.
But you're not buying the country; you're buying the stocks.
Yeah, right now, you're probably likely to get a pretty nice rally in Chinese stocks, even more than we've seen, although I base that only on opinion. But again, if you're going to fix what's wrong in China, it's going to take a lot more than second mortgages and some fun to buy stock prices, stocks.
Where do you want to go from here?
Let's skip the recession thing for the sake of time.
Are we having one?
Well, just what I had in the doc was Ben Castleman wrote at the New York Times that, in fact, there was not even a recession in the second quarter or whatever it was at 2023.
Did you write about this? There was like a technical reason why or not a technical reason. They had to go back and revise, and it turns out it was 22 recession never happened.
Right. Yeah. There's no longer 2 consecutive quarters of negative GDP according to the data.
And the revision was not out of character with what we normally do. It wasn't some weird thing.
No, it's not. But it speaks to how data gets revised.
And Enber never said, it's a myth. They never said it's 2 consecutive quarters. It's a general decline in business activity, which never took place. All right, moving on. We're so rich. Economic has a chart. I can't remember. I don't know who he pulled this from, but household wealth, less
the Federal Reserve.
Total national debt is just hit a record high. And listen, these are the numbers. These are the facts. And I think a lot of this is trickling its way into the market, and part of why multiples have traded higher today than they have, and not just today, high over the last 20 years than they had over the previous 100 years before that.
So if I may, household wealth, which is net of debt, not net of national debt. That's a whole different. Right. So household
assets minus
household
liabilities.
Net worth.
Yeah.
So take out the credit card debt, take out the mortgages, and what's left is $160 trillion. Never before have we been here. So this is well above the pre-pandemic high. We were at 60 trillion 15 years ago. I want people to understand that. U.S. households in 15 years have added $100 trillion in wealth. Now you can say, well, what's the dollar worth? All right, fine. Kill yourself. because that's not what matters.
Whoa.
What
harsh.
matters is this money has to be invested.
Well,
It has to.
So two things.
People with assets have never been richer.
Sure, but two things. First, I apologize. I don't know what household net worth less total national debt
Forget about the
means.
national debt. Forget about that.
But household net worth is 150 trillion or so. Just to be clear, that includes stock prices. So it's not like that money has to be invested. That money is already invested.
Well, it is invested.
That money is
That's-
invested.
It has
That's-
to be, and it is.
It
It's not
has
money
to-
still to be invested.
Yes, I'm sorry.
Yeah,
It's
yeah.
not cash on the sidelines.
It's cash
Right.
on the sideline for someone else, right?
Do you know that? Do you know that stock market wealth is now like almost double home equity?
Yeah. Really?
Yeah,
I have to go-
It's so much bigger now than home equity. Well, I mean, it makes sense. Like the growth of the stock market over the last 20 years
Sure.
versus the growth of the average house price.
I will check. I mean, the problem with that data, and I have to go back and look. That'll be in the flow of funds in the national accounts for the Federal Reserve. But the problem with that account is the vast majority of people don't own stocks in any direct fashion. They have 401ks.
It's not per capita.
No, it's
I'm
not
just-
per capita.
I'm
That's
just
right.
Giving
Yeah.
you the
No,
overall
and
number.
we know wealth is concentrated, but
Yeah, I mean, there's 90 million owned homes.
and wait till
That's-
the $7 trillion in money market funds comes into the market. So all right, Dan, now it's time to cook. What is your gripe with cash on the sidelines?
I think you and I agree on this, but we disagree on the mechanics of how it works.
Okay, there's no disagreeing with what I'm about to say.
Well,
But
it is Rosh Hashanah, so
you already
I'm gonna give you
alluded to
that.
this before when you talked about normalizing something. I alluded before, like people go on TV and they sometimes say things, and I like not that I'm a genius or anything, but I think there are sometimes things people just get into the ether. Stocks go up 7% a year, for instance, and everyone just repeats it as is. The consumer is 70% of the economy, can probably be in that category as well. But the $6 trillion on the sidelines number is one that just bothers me because it's so obviously stupid.
Well, no, it's misleading.
It's misleading.
Yeah.
Because
it's never coming into the market.
It's
Well,
not true, but it's misleading in terms of the implication.
Yeah, no, that's right. So I just listen. Some of it comes into the market, but the implication there's $6 trillion
that it's about to be
it's
put
about
to work
to be
in
put to
stocks.
work. And
Yeah,
so
we agree there.
Two
Okay.
things. One, and you can throw up the chart. One is
Do we have,
there's no
do we have
cash.
Dan's chart? Okay.
There's no cash on the sidelines. There's
What is this?
okay. So this is the money that's been put. This is not my chart, but you guys showed it to me. This is we can measure how much is in checking accounts, and this is that number, and this is the
4.5 trillion.
This is the we gave people $600 and then we gave them $1,400.
chart. Oh my God.
And wages went up. This is that data.
That's not intervention.
Yeah, no.
That's
No,
not
this
trying
is the good type of intervention. This is the Peter Luger intervention.
Okay. What is this?
Some other guy's chart.
All right, let's go to the normalized chart.
We'll do that later.
Cash as a percentage.
Yeah.
of.
So the first point is when people say there's cash on the sidelines, it's not on the sidelines. It's in something. It's in treasuries. It's in checkable accounts. It's earning interest, et cetera, et cetera. It is not an easy swap for NVIDIA or Microsoft or whatever. But more importantly, and we alluded to this several times, numbers go up. And so over time, cash in the sidelines, cash in money market accounts is going to go up. And you have to normalize it for something to show it some frame of reference for understanding that
So
$6
what should be
trillion.
the denominator?
Do we have my
Yes, we
chart?
do.
So
Money
I,
supply.
no.
Okay.
It's
Well, you could do money
or
supply.
it's this
That
one?
one. That's
This
good.
is
That's good. That's good.
No, that was it.
Yeah.
We're gonna have to do
Oh,
some
yeah, yeah,
major
yeah.
editing
Yeah,
right
No,
now.
let's go, let's go, let's go.
Look at this.
Yeah.
Yeah.
That is
yeah.
that $6 trillion
Okay.
number
That's the mic
divided
drop.
by the market
Yeah.
cap, and there is nothing impressive about that.
Correct.
Now, that is not to say that some portion of that, and first of all, that's a lot of first of all. Third of all, some portion of that is institutional, some portion of that is retail.
It's
so
almost half and half, I think.
it's not moms. No, it's skewed. I think like maybe 70-30.
Is it? Okay.
We can check, but it's not moms and pops that are sitting on $6
Dan,
trillion.
if somebody says that on TV and you're watching, if somebody's like, one of the reasons to be bullish is that there's $6.4 trillion in money market funds, that's what pisses you off because the person's acting as though that's going to be like a support to that's like the third leg of the stool.
So when
Yeah.
Dan sees that, he calls the producer of
No,
CNBC and goes,
put me on. Yeah, put me. This is Brian Jacobs at Altus Capital Advisors. You've probably heard the phrase cash on the sidelines used in market commentary, suggesting there's a huge pool of money waiting to flood into the market. One reason this phrase persists is that the nominal amount of cash regularly hits record highs. Most recently, households have been holding more than $4 trillion in checkable deposits. So he hates this shit too, Dan. This
Yeah,
first chart
and
that we
again-
had is the checkable deposits. But let me get to his point real quick. I want to hear what you think. When we look at the data more carefully, cash as a percentage of total financial assets has been remarkably steady for over 20 years. That's the second chart with the colored bars at about 15% over time. And you can see that here. This is going back to 2004. This is the composition of it: money market funds, savings deposits, check. It's roughly the same number as a percentage, which is the point that you made. And then the last thing here, let's do that last chart, percentage of financial assets. So he says, in more recent years, we've seen a rise in money market funds and a continued decline in savings deposits. So it's one offsetting the other.
As you should.
As you should.
But that's the point. It's cash. It's
the bottom line is cash is always moving.
It's cash. It's not money that's going to flood into the stock market.
Yeah.
And when people don't normalize the money markets, it's the same thing with Berkshire's cash pile. Of course it's growing. What?
Yes.
His liabilities are growing. Of course it's growing.
He's an insurance company. Right.
So anyway, so it's just one of those things like 7% that gets repeated.
But that being said,
Wait, by the way, Dan's chart, the money funds as a percent of S&P market cap.
It's great.
You can apply that same sort of methodology to buybacks too, by the way. Record buybacks.
Yeah, record buybacks, record stock market.
But then, exactly. When you divide it by S&P
margin
market
debt,
cap, it actually just goes.
What about margin debt? When they show you the chart of margin debt without the denominator of the size of the stock market.
Let me tell you how long. One of the posts, if you find it, one of the posts on Big Picture is from me in like 2009.
Yeah.
Screaming about margin debt and what just a stupid observation this is.
Because this was a popular chart to put on Twitter.
Right.
Margin debt has never been higher.
It's the stock market.
Right,
yes,
right,
the
right.
stock market in
Tells me
2009
nothing.
went up 50%.
Tells me nothing.
How is this not a bubble? John, can you click that link and just put us on the web? This is the Wall Street Journal today. Wall Street races to bring private credit to the masses. I know this is one of your pet peeves. People talk about private credit and they don't know what it is. It's still I don't need to know it as well as you do. I know what it looks like. I know what it sounds like. The asset class is interchangeable. You could tell me NFTs, private credit. I will tell you that this article is the seventh inning. How is it not the seventh inning?
Okay. Let me just start by saying there's nothing similar between private credit and NFTs.
Other than that, you understand what I mean?
I know what you're saying.
It's an activity bubble.
Listen. Okay, so
not a valuation bubble, an activity bubble. The amount of people all rushing to do the same thing at once. Forget about valuations.
To do the same thing, to provide the private loans. Okay. Sure, there's
Citigroup just came over the top like Superfly Snooker with a $25 billion private credit fund that Apollo is going to put to work. Is there any universe in which Citi of all banks puts $25 billion to work in private credit in a non-insane manner?
It's a $2 trillion asset class.
If investment grade companies start getting involved.
But they're not the only player. Everyone is involved.
Yeah, listen, I'm not saying that this is not a pet peeve of mine, but I'm not, although there are a lot of people who talk about high yield and private credit and that sort of stuff without a deeper knowledge of it. But listen, all private credit is the same type of middle market and lower quality loans that were being done by the banks in a pre-Dodd-Frank era.
Which they no longer do.
Which they no longer want to do, can do. And so you've seen the birth of Blue Owl and Ares and all the private lending funds that are now just providing $500 million loans, in some cases $1 billion loans or smaller, and they're not, the essence of the difference is they're not broadly syndicated is the word you use.
Which is probably a good thing, no?
I am not suggesting the loans are going to blow up when I talk about a bubble. I'm suggesting none of these people are getting the returns that the back tests are making them think they're going to get because of how crowded this type of activity has now become.
Well, if I worked at Blue Owl or KKR, one of those guys, what I would say is, listen, we've been doing it. We're getting those types of returns. We have a better relationship with the borrower. We can construct the covenants in the loan documents in a way that's beneficial to everybody and doesn't have the type of liability management exercises and blowups that traditionally happens in the public market. And that's been largely true for those larger lenders. There is certainly a mad rush to get involved in private credit.
At least we agree on that part of it.
So it's an activity bubble, but to Dan's point, it's not a bubble that's going to burst.
I'm not saying that.
Okay, so I think what will probably happen is because there's so much competition for these deals, because there's so much capital coming in, returns will be lower.
That's all I'm saying.
Yeah.
It has to be that way.
Has to be.
But the retail investor is coming in now.
Yeah.
and will be coming in the next 2 years.
Well, because the institutional investors are tapped. 30% of the portfolio is already in private assets. For retail investors, it rounds down to zero. The thing that triggers me a little bit, or at least, has my antennas up, is this private illiquid stuff coming into an ETF wrapper.
Sure.
That is wait a second.
John, on that screen, put the private credit assets under management chart. I mean, you could remove the asset class from this.
But a lot of this is regulatory. It's the banks. It's not activity that wasn't happening. It's just shifting.
I get it. But it's just like anytime you just scroll down, I'll show you where to
scroll
stop.
to the chart that looks like a bubble.
And then we could,
you'll know it when you see it.
And then we could move along. But these are
there we go.
Okay, come on. So these are very expensive products. They're typically sold to sophisticated investors, and now they're being sold to people who wander into a bank branch and have a financial advisor who sits in a felt cubicle, and that's not the way they were normally sold. And there's no way that version of a private credit sleeve is going to be as good as the back test of the asset class itself. It can't possibly be.
But who am I to tell that person that they shouldn't be able to access any given asset class?
Access or bet on?
What you would argue, I think, is RIAs and advisors have more responsibility in a KYC scenario to not pitch this to 65-year-old retirees.
Or at least not give them the impression that the returns KKR and Blue Owl have enjoyed are going to look anything like what they're going to get in the format that they're making the investment.
That's fair.
Okay.
That's fair.
So that's when I say bubble, I'm thinking from the perspective of the massive investors.
But Dan, could you describe for the audience the difference between Blue Owl making a direct loan versus the way that the banks used to syndicate these loans?
Well, roughly speaking, there's no difference. But the BSL market is exactly what you think of when you think of I'm JP Morgan or some syndicate, and I provide a loan to a company, and then I don't want to hold on to that loan. I'm selling it to a bunch of investors.
Like the way they raised money for Elon's Twitter purchase.
Something like that. That's right.
The banks make the loan and then they offload the loan to investors.
With some of them, but
not in this case.
But isn't there a big difference between that versus Blackstone or whoever being able to negotiate directly when it's one-to-one?
The argument is that private lender, and the argument is that I can work more closely. I know this customer, this borrower more closely. We can construct a set of documents that serves both of our purposes, and then ultimately I hold on to that loan.
You can do a workout. You have all the skin in the game.
I have all the skin in the game.
You have all the motivation
and the
to work this out.
The terms are malleable. You could, if the company gets into trouble, you could extend it or
broadly
whatever.
syndicated by definition means other parties are involved. It's a little more difficult.
Well, that is every man for himself.
Then it's in court.
Yeah.
And that's, when there's a renegotiation or a distressed exchange, as we call it, it can be pretty messy. And that's given rise, at least in the public markets, to what you may have read about, this whole liability management exercise or creditor on creditor violence, which is, to your point, a function of the degradation of document quality and the covenants. And so it's gotten to a scenario where sponsors and lenders and everybody is fighting for this value creation in
so
these
terms get looser, rates come down.
Looser. And
There used to
I'm
be
trying
a
to
document.
oversimplify.
Now it's like, we'll whack it up later.
Well, one of the things that people are concerned about is that we haven't seen an economic downturn in quite a while, a real economic downturn. And so what happens if and when, because ultimately there will be an economic downturn, what happens if and when that happens?
Well, what Blue Owl would say, what KKR would say is, that's on me.
Yeah, we have the most at stake.
We have the most at stake to make sure that this loan is constructed in a way that doesn't damage my investors.
Well, so let me append that. We have the most at stake. It's just us and the people who bought our interval fund, the people who bought our mutual fund.
Yes, but the customers of Ritholtz Wealth Management did not buy those funds.
No.
Those are presumably sophisticated, high net worth individuals, institutions, et cetera, looking for uncorrelated returns.
Wall Street treats sophisticated and wealthy as though they are synonyms.
Sure.
And we all know wealthy people who are unsophisticated. We all know unwealthy people who are highly sophisticated.
Listen, we're going to agree on a lot. My point is just there's nothing unique or new about what private credit funds are doing.
I'm glad to hear that. I feel better because that's not my area and I don't have an expertise, but I do understand when wealth managers are pitching something really hard. I know they're being paid a lot to do it, and I know it's probably not going to have a great outcome for the last people in the door.
I legit get 7 emails a day on private credit.
I get DMs we're syndicating a loan. Do you want to be in? I'm like, the f*** are you talking about? I'm an RIA. What? You need me? That's bad.
So
That's
the
a
way
bad
that I
sign.
take advantage of this is I own the stock. I own Blue Owl, which right this second is hitting an all-time high.
Of course it is. Hey, tell me about Finland.
What?
I've been dying to hear.
You went to
this from
Finland?
So this was an interesting post from Sherwood News.
Tell people what Sherwood News is, by the way.
Yeah, so disclosure, I consulted on this project that is an offshoot of Robinhood. Robinhood owns the Snacks newsletter, which has a massive following.
How many people are following Robinhood's content?
That's a good question.
They don't share.
I think the latest disclosures would tell you that Snacks newsletter is somewhere in the neighborhood of like 30 million subscribers.
So for people that don't understand 30 million, this is one of the largest audiences in finance.
Yeah, it's unbelievable, and it's an engaged audience too. So building off of the success of the Snacks newsletter, which historically just sends one newsletter out every day, they built a newsroom and a site called Sherwood News that's now doing some original content, which includes a lot of really sort of accomplished veteran reporters and bloggers and up and coming writers and personalities. And stuff.
You're in the mix. Our friend Jack Rains is in the mix.
Yep, Jack Rains and Matt Phillips, others. Yeah,
Matt Phillips has been on the show for sure.
Yeah, Luke Kawa from Bloomberg for a little while. Yeah, a lot of really great people who are doing.
So you guys are. So that's an interesting thing because you guys are all veterans. You've been covering markets for 10 years, 20 years in some cases, and you're now doing media about the markets for an audience that I think is like mid-20s to early 30s.
Yeah, and
you're telling them a lot of things for the first time that people in this room take for granted.
And the interesting thing about the opportunity there is, it's actually, kind of like what we were talking about with Amazon, right? The audience already exists. This is not a
They're there already.
They're there already. So
this
is not so much about, obviously you want to grow audience. Everyone wants to grow audience, but it's not a site that has to desperately go out and play the SEO game or the social media game to bring people in.
That's right.
So as a result, there's a little bit of flexibility there where, they can actually have writers do stuff that's like interesting and, risky that might not normally garner, a high click, viral audience.
So if I write something for Forbes, it has to have something in the headline that's going to get people to click it.
Right.
Because nobody is going to be there otherwise. If you guys put something out to the Robinhood distribution list, it's possible like 5 million people are going to see it.
Right.
And no one else in financial media can claim that right now.
I mean, some can, but
like Yahoo Finance.
Yeah, I mean, it's a tough business because the economics are just brutal. Because again, you have all these costs, whether it's the existing staff and the economics of
they have to pay for traffic.
Yeah, you have to pay for traffic and all these things. Whereas with them, they had an incredibly successful newsletter. And now they're just giving that existing audience a little bit more to
Okay, so what's this story
about?
about?
So this is something that came out about a month ago, and it was based off of a study called the Gallup Emotions Report. And so basically the inspiration behind the story was, that there's these surveys that go around. I think the World Bank is involved in this, the happiness surveys. What are the happiest countries in the world? And they use metrics like social safety nets and health outcomes and things like that, right? And so you always get these countries from Northern Europe ranked very highly. And then, of course, the U.S. is very low for whatever reason. And then people started to realize that, this doesn't really, anecdotally, people start to notice it doesn't really make a lot of sense because there's actually a lot of people in Northern Europe that seem pretty unhappy.
They have high suicide rates there.
They have high suicide. There's a lot of issues. There's a lot of issues up there.
It's pitch black 7 months out of the year. We'll start with that.
So Gallup follows up and does another survey called the Emotions Report where they ask really simple questions like, how many times do you smile a day? Or how many times do you get angry? How much time do you spend being stressed out? How many times did you laugh today? Like real straightforward things that it's like, well, that's actual happiness, right? As opposed to what might be associated with happiness. So this is, and by the way, this all speaks to this whole issue of how economic prosperity or financial prosperity does not equal good vibes. I think this is actually something we've been talking about for years now, the whole vibe session thing, right? You have record unemployment, stock market up, housing is up, everyone in America is unhappy. So this first attempt it's like, so on the left side, these are countries ranked by the World Happiness Rank, which is based off of these.
Which has now been debunked, basically.
Which is more or less debunked by this study, where on the right, these are countries ranked based off of emotions. And it's just completely different. And it's like, there's a lot of countries there that you don't really associate with,
Yeah, what are the Kuwaitis so excited about? Like, calm down. Probably because they're all rich. This is a weird one. Senegal, the World Happiness Rank said they were 99th, which is not good. The Emotions Rank says they're number 10 in the world.
Yeah, I'm sure there's going to be issues and more things to be explored here, but I think the bottom line being that it's more confirmation that just because you have a lot of money, just because you have 3 houses and 10 cars, does not necessarily mean that people are just happy.
Why aren't we on here?
I think the U.S. just always surveys poorly.
Okay, all right. Well, listen, it's one of these things where, like the rest of science, there's a replication crisis. All the things that they've been quoting, all these studies,
Sure.
they can't be repeated because they were fake to begin with.
Yeah, but I do think it's interesting, and I think it's something to continue paying attention to because again, we keep getting sentiment surveys where people are frustrated, unhappy, and they're trying to figure out ways to get around that. And apparently, being employed and being able to pay bills is not enough.
I want to go to, as the last thing we'll do today, the stock market rally broadening out. Talk about a reason to be happy. You would think that this would lead to massive outperformance by active managers. And Savita just dropped a haymaker this morning. And she was basically like, no, it didn't help. Were you surprised by this?
What environment do we need?
That's my point. What is the environment that active management shines in? So in the third quarter of 2024, it's one of the best quarters of all time for individual stocks. There's a high number of individual stocks went up. 67% of individual stocks beat the index. Think about how dominant the Mag 7 have been relative to every other stock. That totally flipped this last quarter. So you would think if you're a stock picker, this has been an amazing environment for you. And it turns out not really.
Well, the problem with this is if you're an active manager and your benchmark is specifically the S&P 500, you've spent a year more being at least market weight the large cap tech stocks, if not overweight. This is a point Adam Parker keeps making. You have to at least be where they live. And if you're going to really outperform, mathematically, it's just very difficult to do it without being 6% or 7% Meta or 6% or 7% Google. You need to really lean on those names.
Those stocks are killing you otherwise.
Otherwise, you're just at best market perform. And so you've spent a year and a half just orienting your portfolio in that direction. And then all of a sudden in the third, and it's obviously getting worse over the last couple of quarters. And then all of a sudden in the third quarter, you have this 2/3 of the index are outperforming and the Mag 7 do not. Active management is not going to, I imagine, flip that quickly after so long. There's just not enough time to see what's happening. Although that is, rate cuts are starting, and that was sort of the
Look
impetus.
at this from Chartkit. I forgot to put this in the doc. So we're looking at the S&P 500 members above the 200-day moving average versus the NASDAQ. And we've got 78% of the S&P above and only 45% of the NASDAQ above. So he plots the difference between the two, and it's stretched. The NASDAQ is underperforming to a pretty large degree based on this. And if you look at the Mag 7, so we have the S&P at an all-time high, the equity at an all-time high. The only Mag 7 name making an all-time high is Meta.
Yeah.
And the other 6 haven't made an all-time high in quite a while.
Tesla way off the high. Amazon materially off.
Google too.
So this is Savita. Just 28% of large cap active funds outperformed their Russell benchmarks in September, bringing the third quarter hit rate down to 24%. Underperformance was broad-based. All styles, core, value, growth, all sizes, large, mid, small, lagging their benchmarks last quarter. Although healthier breadth was a tailwind for actives, funds were not positioned for the market rotation, which she says they were underweight dividends and utilities and real estate or whatever. But it just goes to show, you hear, we could put this, I don't know if we could put this chart up or not, but this is just gives you the extent of how broad-based the underperformance was. Yeah. It just goes to show, there almost is no environment in which a majority of active funds are going to, put up amazing numbers.
No, a majority will not.
Not a majority.
A majority will not.
But
Yeah.
at least the underperformance was nice.
Well, but what I would just say about Solus, and I can't comment on our performance or our holdings, but we don't do large cap tech. I don't think I'm breaking any SEC rules by saying that. So we're not in those large names, and so we're always in other names. And so when you see a broadening out, so to speak, the likes of which we saw in the third quarter, I am incredibly enthused by that because it means the rest of the world in which we traffic, mid caps,
It's great.
small caps, troubled names, and even lower down in large caps. That's fantastic for managers who do active investing, aren't benchmarked to the S&P 500. At least we all kind of are benchmarked to the S&P, but aren't specifically benchmarked to the S&P 500 and don't do large cap tech. The third quarter was great. You start seeing all these names start doing really well.
I'm just surprised that it didn't translate. You're saying like it's just not enough.
But these
time.
are, if I understand Savita's data set properly, and I think Savita is one of the best on the street, certainly at this stuff. Those are like mutual fund managers who are specifically benchmarked to the S&P 500
No.
and are trying.
Mid-cap funds also struggle to outperform. Like large cap funds, most small and mid-cap funds also lag their benchmarks last month and quarter, posting similar Q3 hit rates of 27 and 31% respectively. Outperformance rates for small cap funds were dragged down by a particularly tough July when only 14% of funds were able to beat the 10% pop in the Russell 2000. So this is not large cap growth. This is across the board. Active managers weren't ready for the shift in markets that we saw last quarter.
I have to look into the data, but what I will say about the shift, the funny thing is coming into the year, you mentioned Tom Lee earlier. One of the reasons Tom Lee said, well, the Russell's going to be up 50% or whatever, and one of the reasons I was arguing that you were going to see a broadening and small and mid caps would be where you'd want to be is because finally we were going to start getting rate reductions
And it happened.
by the Federal Reserve. And so the point is obviously in the first quarter that got pushed off because you had that spike in inflation, which delayed the rate cuts that would have otherwise happened probably in March, if not April. And so that outperformance continued on the part of the mega cap tech names. By the time you got to the summer, it was pretty clear that by the fall, these rate cuts were finally going to be here. So the funny or the interesting part about that chart is, even though we knew that rate cut was coming, whether it was this month or that next month or the month after that, you knew that rate cut was coming. And if you believed, as I did, that those series of rate cuts would be the impetus for the broadening out, it was finally here, and you still couldn't have positioned your portfolio in a way that would have.
It was hard to know all right, it's going to broaden out, but like, what's going to work?
Well, that's all separate conversation. But the broadening out was exploitable if you were ready for it.
Do we want to do this?
And by the way, all that's supported by the fundamentals too, right? It's not just the price performance broadening out, but earnings growth expectations have been broadening out.
Do we want to do this? Policy thing really quickly?
No.
Stock market historically overcomes.
That's a lot.
We'll save it for another day. All right. Did you guys have fun on the show today?
Yeah.
You have fun on the show today?
I'm sweating again.
It gets hot in here because we shut off the AC. Because we really want you guys to feel the pressure. No, because it sounds better. It's better for the listener. We love the listeners. Guys, we're going to do some favorites and we'll get out of here. Michael, I'd like to start with you this evening. Have you brought a favorite for the crowd?
Is anybody watching, what's the Netflix Rabbi show? The show with
Yes,
Kristen
I watched
Bale?
the whole thing with Sprinkles
this
weekend.
Did she love it?
Do you know what we're talking about?
Which one?
What's it called? What's it called? Something with Us? Netflix.
Nobody wants this.
Nobody wants this.
I didn't watch it. Yeah.
So it's a rabbi played by the kid from the OC, Seth Cohen, whatever his name is.
Adam Brody.
Adam Brody.
Yeah. Adam Brody.
And then the girl is Kristen Bell, who is
She's a goyim.
Good in everything. And he starts dating her, and she's like obviously not in the tribe.
She's a podcaster.
She's of course she is.
Yeah.
Right.
It's cute.
How could you not be these days? It's 2024.
I don't watch that stuff normally, but Sprinkles got hooked, so I watched it with her.
What do you normally watch?
Like anything but that, honestly. Literally, I watch movies. I like all the shows on Netflix. I watch.
Oh, did you watch the second episode of Penguin?
This is like a drama.
Yeah.
Oh, don't spoil that, by the way, because that show is
Quite good.
amazing.
Quite good.
Amazing so
Colin
far.
Farrell is
Yeah.
off the chain in that show.
Yeah.
Anyway, nobody wants this. It's a good.
It's drama,
Very popular.
Drama
Yeah.
or comedy? Or
It's a rom-com.
rom-com.
Yeah.
It's good for this moment. It's light enough that like you watch it and it's like entertaining, and the episodes are 30 minutes.
It's easy.
It's
30-minute rom-coms. We need more of them.
25 minutes. I'm in and I'm out.
Yeah.
Easy. Easy.
It's super easy. You know who Do you know who the other blonde girl is that she podcasts
She's
with?
great.
Do
Who
you
is
know where
she?
she's from?
She looks familiar.
Bro, she's the girlfriend in Succession.
Oh, of
Yes,
course.
I saw an interview with her. Yes.
She's Colin's girlfriend. Colin?
Yeah.
Yeah.
Beautiful girl. I've
she's
never seen
great.
her in anything else. And I'm like,
Oh,
where
it's
do
so
I know her
funny.
from? She's from.
I saw
All
an interview with her.
Sam, you got a favorite for us?
Actually, I was going to say the Penguin.
It's really good.
I think it's really good.
You saw the first episode.
I saw the first episode.
Can you explain why does he? Why
His
is
lip
there,
is incredible.
Why is there? Why does he have a purple Maserati? It's the only part that's out of character. Makes no sense.
Maybe it comes out in episode 3.
That's
or
a big
something.
plot device, though. They see the car and they know that he's nearby.
Yeah, and it also connects with people who read the comic books and stuff like that. You can't just completely abandon the Penguin persona. You got to do purple stuff, or else the comic book readers.
What did you think of the
you're gonna
second
alienate
episode?
them.
I loved it. I thought it would wear thin, like Colin Farrell in a fat suit, like with an ugly face. Like, all right, the novelty made sense in the movie, and maybe I would watch an hour or two of that.
It's terrific.
It's
thought
so good.
Yeah.
I like how it sort of challenges you to sort of understand where the bad guy comes from.
So everyone on the show is a bad guy, which is why he could be the hero,
Right.
because it's relative.
Right. But I like the idea of like fiction or shows. This is why I'm a big fan of Cobra Kai. I don't know if you guys watch Cobra Kai on Netflix.
Yeah, I binge it every time it comes out.
Yeah, it's like every couple of episodes, the good guys become the bad guys and the bad guys become the good guys.
Yeah.
And it's like it gets into the complexities of how people become what they become.
Sam
If
Rowe
that
is a big
makes sense.
fan of moral ambiguity.
Moral ambiguity. Oh, and one more thing. I saw, this is random, but I saw the O show at the Bellagio this summer. It's a Cirque du Soleil. My favorite is Cirque du Soleil.
Okay.
I've
Big
seen
drug user, Sam?
I've seen 3 shows maybe in like 20 years, and every time I go to this thing, it's just heart pounding because
I'm going to
crazy.
Vegas this month. Should I go to it?
Yeah, absolutely buy tickets. Like this show has been selling out for like 30
Hold on.
years.
Should I go to O at the Bellagio, or I only have one night, or Peter Luger in Vegas? What would you do? I haven't been to the Vegas one yet.
Do both.
You do Peter
Yeah.
Luger and then go see.
All right. What do you got for us?
I didn't know I was looking. I didn't know I had to do something.
Dan's scrolling on Netflix.
What have I watched?
Tell you what, just do your Haftorah and we'll let you off the hook.
So I first of all, you're not going to the Sphere?
I did that already twice. Sorry, not to brag.
Who'd you see, Fish or
I
the
saw
Dead?
you two, and then I saw the Aronofsky movie with Batnick.
The
second time I went.
Aronofsky movie does not count.
It's all right.
Okay. Anyway, I saw Dark Matter.
There's nobody there.
Great show.
Dark Matter was great. I'm a big sci-fi guy. And
That's awesome.
Dark Matter was terrific. And I
I
mentioned,
didn't finish it. Should I finish it?
Yes.
I mean, if you didn't like it, such that
I
you
did
turned
not.
it off.
I did not like it. I don't know why. I didn't
They
finish
landed
it.
the plane.
There's
Very,
so much content.
very softly, mind you.
There's so much content. If you don't like something after 1 or 2 episodes, feel free to move on. And I have 1,000 shows. And then I just mentioned at the start, I watched the Mr. McMahon thing, which was
All right. I haven't like gone deep enough
Quite
into
good.
it, so don't say
Sick
anything.
maniac. It was so good.
it was
I should
quite good.
just do that tonight.
If you're our
Just
age,
watch the whole thing.
especially having lived through the 80s,
I watched it in 2 days. He's
yeah.
truly larger than life.
Who's your
and
favorite
Sick
wrestler?
Oh, it was Ultimate Warrior. Well, I mean, other than
Or
Hulk
Ultimate
Hogan,
Warrior.
It was Ultimate Warrior.
Who's your favorite wrestler?
Yeah, it was Ultimate Warrior, and then
Did you hear my Superfly Snooker
I
reference
did.
today?
I did. Yeah, I appreciated that. That was right when I was getting into it. I remember I saw Superfly Snuka at the Louisville Gardens in like the 1980s. I was like 6 years old.
So I like the Iron Sheik because he had the camel clutch, and when he would put that on someone, the audience would go wild.
Yeah.
I like
Did you ever see a live
guy.
match?
What as a kid?
Yeah.
Yeah, and I took my son back when he was like 8 years old.
It's a whole different thing now.
It's
But
totally
I have to tell you, I'm not a wrestling fan. I loved being there.
Sure.
Like I said to him on the way out, I'm like, we were at the Barclays Center. I've never seen people as into the wrestling match as they like. It rivals football. It rivals, and people are so excited about it.
I always tell the story. The first time I ever went to a boxing match, a live one, it was Pacquiao Cotto
Oh wow!
in Vegas,
Yeah,
and it was almost a race war.
yeah.
And it was one of the most exciting, exhilarating things I've ever been to. Now that's, I mean, I could have gone earlier to other ones, but being at a live, I imagine WWE is a little less race war-y, but the
Yeah, but it's the enthusiasm-
anger in the audience and
enthusiasm
the
is-
enthusiasm is
yeah.
really incredible.
It's like a
All
soccer
right, so
match.
I'm gonna check out. I'm gonna check out the Vince McMahon thing. I should probably do it tonight.
So good.
I want to recommend Audible for insomniacs. Do you guys sleep well? Yes.
You know, it's funny you mentioned that. I'm having terrible sleep right now.
All right. Here's what I'm going to tell you to do. I have a prescription to write you. You download something a book you would never read, not a bad book, but just something that you would never sit down and read, like the classics,
Oh,
like
God.
Dickens.
Oh, that'll put you right to sleep.
I'm doing the Odyssey. It's narrated by Claire
Wait,
Danes.
I have a question for you.
Go
I'm sorry
ahead.
for interrupting. Does this get into your dreams? Like, if you're listening to the Odyssey when you're sleeping, like, are you dreaming
It's
about
a good
like
question.
fighting like the
no,
Hydra?
I don't have dreams because my soul is dead. So I listen to I'm listening to the Odyssey right now. I can't make it 4 minutes. I'm gone. It's like ancient Greek, like whatever, and it's being narrated
It's in Greek.
in a very pleasant voice, and
Yeah.
it's good.
Yeah.
And I just discovered that she also narrated the Iliad. So when I finish this, I got that. I feel like this could last me a lifetime. I can't stay awake for more than 4
If
minutes.
you can't
It
stay
is the
awake, why do you
cure.
need a new book?
No. I wake up at 4 a.m. I put on the Audible, and I'm out like a light again, as opposed to scrolling through my phone. You ever try this? Anyone? All the time.
I just
All
eat
right.
edibles.
Well, you can't
Audible
scroll
for
through the
insomnia.
phone because the
Edibles.
light tells your brain that it's daytime.
Well, that's why you shouldn't do that. You should
Right.
just put on the Audible. So, second one, real quick, live album this week, The Lumineers. They dropped the entirety of a 2022 show they played at Wrigley Field. This is like one of the best bands of the current era, I would say. Underappreciated, not a ton of radio hits, but a ton of hits. And
You don't need radio hits anymore to get that big.
you don't. I love live albums, and I'm a connoisseur, and I know good ones from bad ones. This sounds like $1 billion and just an incredible. It's 32 songs. So, you have to like the Lumineers for 32 songs, but highly recommend. All right, that's it from us this week. I want to say thank you to all the people who have worked on the shows. Nicole, John, you've been incredible this week. Daniel, Rob, Graham, Chart Kid, Matt, Sean Russo, who we're going to have to talk to in a little while. Who else? Did I miss it? I got Graham?
Duncan, we miss you.
Duncan. Where's Duncan? We'll talk. All right. Hey, guys, thank you so much for listening to the show. Special thanks to Sam Rowe and Dan Greenhaus. You can follow Sam on X. He is at Sam Rowe, SAMRO. He's also on LinkedIn. And please visit ticker.co. That's TKER.co for literally daily insights on what's happening on Wall Street and around the economy. Also want you to follow Dan Greenhaus. Dan is on X, Dan Greenhaus. Very simple, DANGREENHAUS. Dan, thanks so much for being here.
Thank you, sir.
Sam. We love you guys. You're the best. Lashana Tova. We'll see you soon.